Hello, Tom and Jane. This is Matt. I'm excited to send this video to you. I have a few findings that I think you might find interesting in your future investment endeavors. So I'm very happy that you have contacted us in the firm and that you're interested in investing. About 50% of Americans actually have some kind of retirement fund that they're investing in, and that it's only 50%, and they're not even sure that they're going to be able to retire on that amount that they have saved up. So it's important for all of us to be aware of what our investment goals are and what we're working towards. And from what I understand from the information that I've been given, Tom and Jane, you guys are in your 40s and you still have some time until you actually need to retire. So I have a few things that I want to show you, a few things that I think will be interesting to you. Now, to start us off, I actually want to talk about risk, about how risky of investments should you be invested in, if we can say it like that. I have a graph here that I want to show you of two investments that are considered very risky because they have a 3-year standard deviation of about 100%. Now that means if the market moves in either direction, it could go down or it could go up a significant amount. You could see also because of the COVID-19 pandemic last year, a lot of funds and stocks went down in their prices, and now they're back up. The market is booming. So we can see here, for example, on this mutual fund right here, that the returns on it are about that's not 18% that you're seeing. That's 1,886% return in just 1 year. Now, on the flip side, this you could see that their 3-year return before was just 44%. So it's kind of a weird time that we're in, and for our purposes, because of what you guys are trying to, your investment goals, I'm going to be focusing more on the long term and trying to keep our 3-year standard deviation at about what the indexes are. And we can see that here on this graph right here. I kind of want to focus more on the 10-year return for you guys, and having a standard deviation that's about where the indexes are, maybe a little higher, because we can afford going into some riskier investments, but we're also going to have a good blend. And I'll get into that a little bit further in the presentation. Now, when trying to find out what kind of investments would be good for you guys, I thought we need some growth investments, and we also need some fixed income investments that are a little bit more secure, have less risk involved. And you can see these are the 6 categories that I suggest, or I guess there are only 5 categories really. In the health sector, having large cap growth, small cap growth, and technology. And then also being involved with some fixed income investments through state or worldwide U.S. bonds. So if we look here, these are, I'm suggesting 2 investments in each of these areas. And I've chosen these based off of they had very low 3-year standard deviations, but also they had very impressive 10-year and 5-year returns, which are what we're looking for. You guys are in this for the long haul. This isn't just something that you're going to get rid of in the next year or so. And also, these are the fixed income investments that I've found for you. Now, if we look here, from what I've calculated out, and this is the mix that I also suggest for you, you can see the different areas right here. We're going to put a lot in large cap and technology, be able to get a lot more growth over the years, but also you could see that our standard deviation is still quite conservative. If I remind you what the indexes were, they were about 21-22%. So we're still pretty close to where we will be following the indexes. But these funds, if the economy starts tanking, these are just going to follow the indexes. It's not really going to go extremely low, which is very important. We want it to beat the index, but also not beat the index on the way down. We want it to stay above. So this is what I've suggested to you. We also have the two fixed income ones to help manage that risk as well. Now, I want to talk to you a little bit about here before I end this video, how important it actually is to meet with a financial advisor. This is something that you shouldn't just put your money into this and then just leave it for the next 20 years. I suggest that you meet with a financial advisor such as myself or someone else inside the firm on a regular basis and looking through your portfolio, seeing if you have any more money that you're able to invest into the market, looking at the market shifts, and also taking into account your age. Usually with age, you want to be in less risky investments, and you might want to move more of your asset allocation to more fixed income or money markets, just more safe investments. But I think right now, you and Jane, you have the time and you have the age to where risk is a good idea in relative amounts, I would say. So thank you for meeting with me. I'm so grateful that you've chosen our firm to help you guys out. I wish you well and hope to hear from you soon so we can get going on these investments and make sure that you have a lovely retirement. Thank you for your time.